All right, everyone. Well, it looks like Dylan might have just started us here. So, hope everyone is doing great and having an amazing summer. Um, let's see. So having an amazing summer. It is time again for our quarterly economic update. And again, we are lucky to have Mark Peterson here. Mark is a director of the Market and Portfolio Insights team. He's a big cheese at the biggest asset manager in the world, which is BlackRock. So we are very fortunate to have him here with us. Mark has been in this industry for 25 years, doing everything from working at the board of trade to working at product strategy. So with that, I'm going to turn it over to him. As always, we will be answering any questions that you guys have. We'll stay as long as you need here at the end. Just once we're done, we'll put a disclosure up that LPL forces us to do, and then we'll be able to take any questions from you guys personally. So with that, Mark, I will turn it over to you.
Great. Thanks, Jason. Evening, everybody. Thanks for having me on your call again. Talk a little bit about the markets and the economy here and heading into the back half of 2025. We'll give you our thoughts here as not only this year, but into next year as well. We'll do through what we call our student of the market piece, which is something normally just for advisors, but we are doing a special client event session here today. So it's all charts and graphs, so bear with me. As Jason knows, I'm a chart and graph person, so didn't leave many in the bag today. But hopefully it'll give you some idea on where we think things are at here in the mid 2025 and where we might be headed in 2026. And it's been obviously a wild ride. You think about we were almost down 20% at one point this year in U.S. stocks, and now we're up about 6-7% year to date. So a bit of a bumpy ride, but we'll fill in the gaps on why that is and where we think things will go from here. So with that long preamble, let's get after it and just look at the markets year to date and what we did in May, June. I mentioned we were down at one point almost 20%, but look at what we did in May and June. US stocks were up almost 12% in May and June, 11.7 you see on the far left hand side there. And that was the best May and June in US stock history, at least going back to 1950. So pretty historic, rarefied air there. You can see year to date, we're up about 6. We're a little bit more than that. Probably the other big story this year is international stocks actually carrying their weight in the portfolio, up about 19.5%, about 20% in portfolios. It's been a long time since we could say that. Internationals underperformed U.S. stocks 12 out of the last 15 years. So been pretty rare, but we're back in a place where international is actually adding value to the portfolio, which feels good. I think we all expect it to add value, provide that diversification. That's exactly what's happening this year. Bonds have given up a little bit since the end of June, so we're up maybe about 3% now in bonds and fixed income. But overall, good story. I think overall diversification's back. You're seeing the well-diversified portfolio pay off in a big way this year. And again, that's a little bit different than what we've seen in the last couple of years. Last couple of years, U.S. stocks have dominated, right? They were up over 25% 2 years in a row, 2023, 2024. That's only happened 5 times in history where you get 25% or better back-to-back calendar years. So makes sense that you see other parts of the portfolio really stepping up. Here's what happens the months of the year when you have such a very good May, June, and very similar to last year, actually, where we finished off the rest of the year up 8.4% for that last 6 months. And you can see some of the other periods. Not every one of them is positive when you have a good May, June, but a majority is. And you can see in the bottom right-hand corner, you're up about 7% the next 6 months, which would be a nice pace for us for the rest of the year. So really nice May and June for U.S. stocks, but international stocks leading the way. That continues here in 2025. And I think one of the key catalysts for international versus U.S. stocks is what happens with the strength or weakness of the U.S. dollar. So think about this almost like you were traveling overseas. When you have a strong U.S. dollar, your dollars buy more goods overseas. So it benefits in a strong dollar world to travel abroad. The exact opposite is in a weak dollar world where it actually benefits to own international stocks because their earnings, their stock price will actually be worth more dollars in a weak dollar world. And you can see these cycles can last really could go anywhere between 6, I think, is the shortest cycle that we've seen, but they can last as long as 12 years. Certainly, that's one of the longer cycles that we've been in here lately. So these cycles can last a long time. And the thought is maybe we're starting to enter a weaker dollar cycle, which will lead to better international stock performance versus the US. You can see on the far right side, look at all the numbers here, but we broke it out. International stocks, look at how much they outperform US stocks whenever the US dollar is weakening, right? It's just across the board a big determinant on US versus international stock under and outperformance. And you can see, look at this recent period, how much US stocks have outperformed international because the dollar's really been in a strong dollar environment since the end of the global financial crisis back in 2008. So thought would be helpful to understand that distinction, that really key factor in deciding whether international stocks add a lot of value to the portfolio like they have this year. We think this might actually continue through the year. Some of this is policy driven, some of it's interest rate driven as well. Always tough to call, turns in the US dollar, but we might be entering a period where we see a weaker dollar, and again, international stocks will benefit.
Hey, Mark, can I add to that a little bit? I think people have a tough time grasping why a weak dollar is good for investing. So most of our clients live somewhere near the Canadian border, right? So if you think about it in these terms, if you were looking at a cottage on Lake Erie or Ontario or St. Clair or Huron, somewhere over there in Canada, but close to the US, and you were looking at it last year and it was 500 grand, and you would even beginning of this year, and then you went back and you said, okay, I'll take it, and you tried to bring your 500,000 American dollars to Canada, what they're going to say is, no, 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 no. We're the same price at 500,000, but we now need 550,000 of your dollars, right? Because the US dollar has depreciated by 10%. So that property in Canada is the same, but because the US dollar depreciates, it now takes more dollars to buy that, which means it looks like that piece of property appreciated 10%, but it didn't appreciate at all, actually. It was just us as Americans with our weaker dollar. It took more weak dollars to buy the same asset. And that's true if it's a vacation home, or that's true if it's a share of, Volkswagen stock, right? So as our dollar goes down, it's not necessarily that international is doing amazing. It's just that it takes more of our dollars to buy it. So to us as Americans, they seem more amazing. And they've done great this year, and that's why we continue to have exposure in our portfolios.
Yeah, and certainly beyond just the dollar too, international stocks didn't have high expectations going in the year, so fairly cheap,
Valuations were
and
low.
earnings expectations were not high either. So a combination of all those factors have led to the outperformance. But I think that's a great description of how that dollar dynamic plays out when you look at assets both here in the U.S. and globally. The other thing we talked about this last time, if you weren't on the call, you can see what I do all day with my time. Just looking at the number of days the stock market's up by 2% or more, or down by 2% or worse. And we've had 12 so far this year, which is twice as many as we had last year, 6 times as many as we had back in 2023. But this is a good way to look at the market because it tells you what the market's thinking about the economy. You can see, look at all these periods. Either volatility is with us and in our face, or it kind of fades to the background. In some of these years, you have 0 of these 2% trading days. And whenever the market's jumping around quite a bit, day to day, week to week, month to month, the market's worried about where the economy is headed, and the ability for companies to continue to produce earnings and profits, pay out dividends that help support stock prices if the economy is on the edge of going into recession. That's what the fear was earlier this year when we had some policy uncertainty, concerns about tariffs. There was the market jumping around quite a bit. We had 8 of the 12 days just in April of these 2% days. So that was right around some of the tariff news coming out, and the market did not take that well. I can tell you it's faded to the background, though, for now. We've had 0 days since May of 2% up or down moves. So I think this is always a good way to feel for what the market's thinking about the economy. If it's jumping around quite a bit like it did back in 2008 or it did during 2020 in the pandemic, or even more recently in 2022 when we had that higher interest rate, higher inflation shock, we had 46 days, right, where the market's up or down 2%. So I think it's always good to connect the dots on this, that if the market's jumping around quite a bit, it's worried about where the economy is headed. And you can see on the right side, economic growth, when you get 10 or more of these 2% trading days, economic growth is less than half of what it is when you get very little volatility. So really backing up what we said there as far as connecting the dots with higher volatility equals concerns about where the economy is headed. But we feel pretty good where we're at right now. This hasn't really changed a ton. The economy's growing well, well above recessionary levels. I think earlier in April, there's concern you might slip into that recession, but it's just not that close, honestly. It's not tremendous. You can see the slowing growth really since the second quarter of last year. Last year at this time, you can see growth has slowed, but still well away from that recessionary level. And I think that's really one of the keys to the story on why the stock market has been able to get back on track this year after being down almost 20% is because there's confidence that the economy is going to avoid recession. The backbone of that, of course, is always the job market. The job market's still not perfect. Certainly some areas of the job market that are soft. We're seeing some layoffs in certain areas, but we're well above recessionary levels. You can see these are the number of jobs added in a given month on the right side of the slide. As long as we stay around 150,000 jobs added a month, that's healthy territory. Certainly not perfect. You're not seeing manufacturing come back in a big way. A little bit of signs of life there. Seeing a lot of leisure, hospitality, healthcare jobs. Government jobs are shrinking, which is a change from the previous administration. But overall, the job picture is well away from that recessionary level. And I think that'll help power us through 2025 into 2026. If the market knows the economy's on track, that'll bode well for stocks going forward. And of course, Jason knows I'm the inflation geek, so always have to work in inflation. And we did get a new inflation number here this week. It bounced a little bit up to 2.7%. Not that it was a bad report. It certainly wasn't good or bad either way. It was kind of what was expected. But we did roll off some really low inflation from June of last year. But we're still in a good level from where we were back in June of 2022. We were over 9%, if you recall, back a couple of years ago. It probably felt worse. There were some estimates because they changed the way they calculate inflation over the years. That this inflation, if you use the old methodology back in the 70s and 80s when we had double-digit inflation, this number would have been more like 16 or 17%. And it probably felt that way for a lot of folks. But this is going the right direction for us. It still means prices are going up. Don't get me wrong. 2.7%, it still means prices are advancing, but they're not advancing nearly as fast as we were a couple of years ago. And this is a natural reality with inflation. Everybody's going to want to try to take credit for the rate coming down, but it really is natural that you're not going to have prices increase consistently by 9-10% in the economy in a well-functioning, healthy economic system. So it's just a natural path for what we've seen. There is some concern about tariffs, right? And the impact there. Hard to calibrate exactly how that comes through the inflation number. I think one of the bigger things to keep an eye on too is this yellow piece, and we probably touched on it previously, but it really is, I think, one of the biggest things in the inflation story is housing has been the biggest component. This yellow bar is almost all housing, and housing is all rents. They don't actually have a single housing price in the inflation calculation. They just ask you what you'd rent your house for. And that is the largest single component of the inflation calculation. It's almost 36% of the index of the overall calculation. Look at how that number, it was slow on the way up. It's now slow on the way back down. It's still almost 4% of the overall calculation, but it's coming down. It's the lowest level that we've seen in a bunch of years, but it is coming down. So hopefully that absorbs some of the impact that tariffs have on this inflation story. And I think especially year end, we start to roll off some really bad inflation numbers. towards the end of the year. You start to get to the fourth quarter, November, December, and even January of this year were really bad inflation numbers. We start to roll those off next year, and inflation might look a lot better heading into 2026. That's really important because it allows the Federal Reserve to lower short-term interest rates, right? If they're not worried about inflation coming back in a big way or anywhere approaching 9%, that'll allow the Federal Reserve to lower short-term interest rates. And we touched on this last time. I won't go any deeper here just because it's so hard to calibrate. All the policy changes in this administration, what the impact will be on the economy and the markets. It's really a mixed bag. Some help, some hurt. I try not to try to really calibrate this too specifically because it's an impossible task. It's really a fool's errand. I think we need to be humble here, right? Keep politics out of our portfolio. Depending on which side of the aisle on, you probably view the economy and the market pretty differently, but understand that the reality is probably somewhere in between. So I just throw that out there, that keeping politics out of your portfolio is probably the best path forward. Don't do anything rash based on your view of the economy and the market, because it might be skewed based on which side of the aisle you're on. So rest of the way, we still like U.S. stocks, large caps in particular. International continue to chug along, but we think the U.S. market's still on track. Like bonds and fixed income in this environment, they've done okay year to date. We still think there's some room to run there in the second half of the year. And as always, lean on that diversification story. We talked about how it's back with things like international and bonds performing well this year. We think that'll continue to be the case for the rest of the year. And of course, we broke out this chart just to remind folks, with all the geopolitical headlines, all the headlines here in the U.S., there's always a reason to sell stocks, right? Or be pessimistic. But look at what stocks have done since the end of 2008 and the global financial crisis. 100,000 invested at the end of 2008 is worth almost $1 million, 851,000 today. That's pretty amazing considering all these headlines. And I was pretty conservative layering in some of these headlines. I could have probably littered the page with even more. But understand that the U.S. stock market's amazingly resilient, right? Just has an amazing ability to continue to add value, continue to produce earnings and profits, even in the face of some tremendous challenges that we've seen globally. And of course, on the right side, this is always one of my favorites, just looking at if you invested at the worst time. So just had terrible timing, luck. But if you held till today, look at how good the results are, right? Every one of these really dramatic, challenging periods in history, stocks were higher if you held till today. Look at COVID, even COVID 2020, if you invested right before COVID set in, you're still much better off than the long-term average for U.S. stocks. I think that's pretty amazing considering you've had a couple bear markets in there. Or even look at World War II. Go back in the time machine, 1940, invested right before Germany invaded Poland in 1939. You're better than the long-term average had you held all the way through. So just time in the market story versus trying to time the market, always the key to success. Just understand, right, all the different headlines we've had. It's been a bad bet to bet against the U.S. stock market, the U.S. economy, not just over the last 17 years, the last 60, 80, almost 100 years now. And we touched this last time as well, but I thought it was worth hitting again, that when you get into some of these periods where the market's jumping around like it did in April, and we had 2 days in the market in April 3rd and 4th, market was down over 10% in 2 days. That's pretty dramatic to see your stocks drop by 10% in 2 days. But it's not uncommon. It happens quite a bit. And this is the COVID period back in March of 2020. You had 2 of the 3 worst days in stock market history. You had 2 days here where the stock market combined was down over 20%. That happens in these volatile periods, right? Don't let that get you on the side of doing something rash with your portfolio. Don't give into that temptation, because look what happens on the other side. You get some of the best days in stock market history on the other side. And that's exactly what we had this April, right? It happened back in March and April of 2020. Well, April 3rd and 4th, stocks were down combined over 10%. But then on April 9th, stocks were up 9.5%, which is actually the third best day since 1950, replaces this March day of 2020. But something that we always see, these best and worst days in stock market history, they sit right on top of each other. They live in the same neighborhood. Understand when the market's jumping around. This is just the natural feature of how it plays out. Just don't give into that temptation of doing something rash with your portfolio or your stock portfolio. It's amazing how often that happens. Probably the biggest mistake we see, folks get discouraged. They get too concerned about the violent moves of the market, but you don't want to miss some of these best days on the other side.
A lot of people, Mark, talk, I know you like to talk about this, and I think it's great to talk about it. And 75% of people or 80% of people will say, well, of course, doesn't everyone know this? Well, not the other 20%. And those are the people who we have to keep constantly reminding who just want to pull the cord on their investments when they see the market go down. I mean, luckily, we always try to set them up to get with the risk tolerance, but it still happens all the time. So yeah, it's even though a lot of people might say this is an old message, it's not for everyone, and we still have to talk people off the ledge all the time.
Yeah, it's amazing how often it happens. Because you're right, it probably for a lot of folks to be like, "Hey, this is common sense." But there were some studies done right around this COVID period. I can tell you some of the big retirement platforms where a third of retirees sold some, if not all, of their stock portfolio in
Yeah.
March after some of these days. So it was even greater than 80/20. And think about it, it was a tough period, right? Think about all the uncertainty around COVID, the markets moving, right, in a very extreme historic way. It was natural, folks, to at least for some folks to have that concern, especially right if you're at or near retirement. You don't want to impair your portfolio. But the worst thing you could do is obviously lose some of these days on the other side. And that's the next slide that we always show in tandem with this one. Every financial firm has to have this slide by law. Look at the last 20 years. If you just would have stayed invested, 100,000 would have grown to 717. Again, pretty amazing considering you have some pretty historic bear markets in there. But look what happens if you just miss the best 5 days. Crazy, the difference in the result here. That's why that old lesson is so important, that time in the market matters, not timing. And granted, you'd have to be super unlucky to miss the best 25 days and be closer to break even. But it doesn't it doesn't take a handful of these days. And it wouldn't have been hard, right? After early April, if you're concerned about tariffs and the impact of the economy, or during COVID, wouldn't have been hard to miss some of these best days in stock market history. So that's why we always beat the drum on this one, because it's amazing how often it still happens in the industry. Just don't give into that temptation. Switching gears on the bond side, this is something we've talked about as well last time, but I think he plays out even better today. This is looking at just inflation adjusted interest rates on bonds and fixed income. And this is just looking at a modest 5-year US Treasury bond. If we just subtract the income or interest rate that you're getting by inflation, so are you actually building on your purchasing power with bonds and fixed income? You're actually getting the best return on bonds and fixed income on an inflation adjusted basis in over 10 years. That's the type of environment you want to start putting money to work in bonds and fixed income. On the right side, here's just whenever you're getting a nice 1 to 3% return or income level above inflation for bonds and fixed income. You average about 5-6% in bonds over the next 12 months. And that's about right what we're on pace for right now with bonds and fixed income. We're right on pace for a 5 to 6% return year, which isn't glamorous, but that's really what we expect out of bonds, right? We want that safety. We want that stability. We want that income level that'll provide a nice diversification and balance with the rest of our portfolio. So we really think bonds make a lot of sense in the second half of the year. You're getting a nice interest rate income level above inflation, especially if that inflation number continues to trend lower into 2026. This could be a nice story here. And stepping ahead on the bond side, I think the other thing that makes bonds look attractive right now is that the short-term interest rate, the Federal Reserve interest rate, is well above inflation. You can see here that rate is above inflation. Usually that foreshadows that the Federal Reserve is going to bring down those short-term interest rates in the future. The market's expecting a couple interest rate cuts in the second half of the year, and that tends to be really good for bonds. Look at the average return for bonds whenever that federal funds interest rate is above inflation, right? Similar story to the previous slide, just illustrated somewhat differently. But a 7% return on bonds versus when inflation is above that short-term interest rate, that's more problematic for bonds and fixed income. We're just nowhere close, right? We're solidly above inflation with that Fed funds rate. That's awfully good for bonds across the board. All the various asset classes in the fixed income world should do well here. We like some of the multi-sector, non-traditional bond categories that balance some of that interest rate risk. But we think bonds and fixed income well positioned in the back half of 2025. One of the last things here is, and we did this last time, but again, I thought it was worth dusting off, just looking at what we call winning more by losing less. So just that story of why we diversify, why we asset allocate, why we spread your investment eggs across a variety of investment baskets. It's all to get to this story. And this is investing at the worst case timing, probably in the last 50 years, is right before the global financial crisis in October of 2007. You lost 55% right out of the gate, right? One of the worst bear markets other than the Great Depression in history. But then you rallied and you rebounded, and then you've had a couple bear markets since. But 100,000 still grows to 505,000. So not too shabby considering three pretty big bear markets in there. But look what happens on the right side of the slide, if you recall. If we capture 80% of the bull and 80% of the bear. So just a chunk of the upside, but also less of the downside than 100%. So instead of being down 55, we'd be down 44. And instead of being up 529 like we are on the left, we're only up 423. Look at what happens to our overall result at the end of the day. You're actually in a slightly better overall outcome than the chart on the left. And you've done so with less risk, less volatility, less drawdown in some of these periods. Look at the bear market periods here, how much better your overall outcome is along the way. So almost a smoother path as well. This is what we're trying to do when we build portfolios the way we do. Win more by losing less. Chunk of that upside, minimize the bear markets. You're still going to lose money. It never feels good. But if you can weather those storms, stay the course, that's how you build wealth over time. It's just sometimes tough to see as you walk through it, because some of these periods can seem awfully painful. Sometimes it doesn't feel great to lose 100% to U.S. stocks either. So just a good reminder why we build portfolios the way we do. And last one for you, I just thought it was important, especially as we move into the second half of the year. And if the Federal Reserve does lower short-term interest rates in the second half of the year, there's a lot of money on the sidelines still. This is the amount of money in money market accounts. So those cash accounts that are paying over 4%, probably the best rate we've seen in a long time. But look at how it's changed. We've got $7 trillion in these money market assets. It was only $3 trillion back 6 years ago in 2018. That's an enormous jump, right? One of the biggest jumps we've seen in history. So a lot of cash on the sidelines, a lot of cash that can be put to work. And I think it would surprise folks to realize that cash has done okay, right? It's been a good safe haven. It's been nice to have back as a tool that we can use in a portfolio. But look at how much better bonds and a diversified 60-40 stock and bond portfolio has done over the last year to date or 1 year period. In fact, just looking at bonds, 93% of all bond mutual funds and exchange traded funds have outperformed cash over the last 12 months. I think that would shock people, right? That bonds don't seem that glamorous, but they've significantly outperformed cash in this environment where cash has done well. But putting your money to work beyond that, whether it's in bonds and fixed income or even the diversified portfolio, you've done even a lot better on top of cash. So I thought that was a good place to leave it. I know, certainly cash is paying well still, but as the Federal Reserve lowers short-term interest rate, that cash rate will start to come down even more into 2026, which I think will be something to keep an eye on. Not that $7 trillion will come out of these cash accounts if rates get under get closer to 3.5% on cash, but eventually these dollars will start to make their way back in to the market. Probably makes sense to get in front of that before some of the returns really price that in. So hopefully that was helpful. Think about where we started. I think, again, focusing on those two key pieces, an economy that avoids a recession with the backbone being a good but not perfect job market, Also, inflation remaining in a reasonable range where the Federal Reserve can lower short-term interest rates. That's a nice combination for portfolios. No recession, lower interest rates from the Federal Reserve. Those are the two key pillars we need to keep on track. That's why the markets rallied back, because we've got back on that story here to May and June of 2025. We think that holds into 2026. So that'll be good news, both on the stock side. We think international could have some legs, but US, we still like the US a lot. We think that story sets up well for the rest of the year. Bonds and fixed income, right? That 5-6% return, that yield and income above inflation, especially above the federal funds rate being above inflation as well. All that points to better bond returns in the second half of the year. And then, of course, as always, embrace that diversified portfolio. It's leading the charge this year with international doing as well as it has, but always leaning into that winning more by losing less story, we think is a winning formula to build wealth over time. Perfect environment, we think, right now for that diversified portfolio. Embrace it. Certainly a story that's got some legs. So with that, Jason, I'll stop sharing. That's probably enough charts and graphs for a Thursday evening, but love to hear what's on everybody's mind.
Yeah, so at this point, like we always do, I'd love to hear any questions that you have either for Mark or myself. It's just a great opportunity to get in front of somebody, that you might not be able to ask questions of otherwise. So anyone can feel free to just unmute, which is the little microphone in the bottom left of your screen. If you kind of hover over where all the pictures are. And then Dylan, I think you've got to put up like a disclosure at the end. So feel free to do that at any time. So if anyone has any questions, I'll give you a couple seconds just to you just go ahead and unmute and ask it. Oh man, someone's just coming right now. So sorry. All right, so
Game to
great.
ask questions.